the BlackRocks of the world don't make bad bets. Like they understand, they do an incredible amount of due diligence. So it's nice to kind of see them endorsing the technology in this way. Like it will just get to a point where I go to my brokerage account, I buy ETH, and in the background it's automatically staking and it's a given.
So do you see ETH continuing to hold that mantle of being, let's say, the top enterprise blockchain?
Oh, absolutely. I think there's no doubt. Ethereum has kind of two key selling points, like security, 100% uptime, and then like you mentioned, liquidity.
This episode is brought to you by Propy, which is leading the charge in putting real estate on chain. Propy is a game changer. You can buy and sell real estate with cryptocurrencies using the Propy platform, which is powered by a blockchain, of course, and they have a native token called Pro. And I've been an investor in the Propy token since 2018. So Propy is a licensed Web3 pioneer operating since 2017. They have facilitated over $4 billion in transactions. They're putting titles and deeds on chain. They use Coinbase for their crypto escrow service. So this is a great platform. And once again, they are ahead of the curve when it comes to putting real estate on chain. And they just launched a great campaign where you can earn some of the Propy tokens. And it's simply by doing tasks such as sharing their vision video, signing up and inviting a friend, and much more. So if you'd like to learn more about Propy, visit the link in the description. Hey folks, welcome into the Thinking Crypto podcast. I'm your host, Tony Edward, and joining me today is Kean Gilbert, who is the head of institutional relations at the Lido Ecosystem Foundation. Kean, great to have you.
Tony, thanks so much for having me. It's great to connect.
Absolutely. Kean, I think it's very timely that we're speaking. There's a lot of demand for Ethereum, a lot of demand for Ethereum staking, and Lido is playing a big part in the staking aspect for Ethereum. And then recently, the SEC gave some clarity around liquid staking. So I got a lot of questions for you, but let's kick it off with your background. Tell us a bit about yourself and your professional background.
Sure. Yeah. So Irish boy, kind of grew up in Dublin, like business background, did marketing, management consultancy. From a professional point of view, I started my career in Deloitte doing like FS, capital markets consulting on crypto. So I did that for around a year. After my time in Deloitte, I joined Consensus. I was in Consensus for around 5.5 years, mainly working on like MetaMask institutional, Infura, staking, tokenization, like a number of different products. So I kind of got good exposure there. After my time in Consensus, I joined a small startup for a while that was doing like portfolio and risk management for crypto funds. And now currently I'm at Lido for just over a year. So I'm head of institutional relations and I would look after a lot of institutional clients. So by that, I mean different crypto funds, asset managers, hedge funds, like really anyone who has a significant amount of ETH. And we would obviously encourage them to stake it with Lido for the added benefits of liquidity and capital efficiency.
Very cool. And at your time at Deloitte, what was your first encounter with crypto? Was it Deloitte's, were they researching this technology and then you kind of got into it, or did you find out about it outside while at Deloitte?
Yeah, it was kind of an interesting one. So in college, when I was doing my master's in consultancy, we had to do a consulting project and my client was Deloitte. So that was kind of my first, I suppose, aha moment for crypto and blockchain. So we did the consulting project for Deloitte and this would have been, I think, 2017. So the technology would have been quite nascent. So all the work that Deloitte was doing at that time was very educational based. Like there's getting people to understand that like blockchain and Bitcoin wasn't the same thing. Like one is a technology and the other is use case. So yeah, college would have been the main dip to kind of getting into that kind of crypto part. But after that, a lot of it proof of concept based. So nothing was really going into production at that point. You were doing a lot of use cases around like trade finance, which was quite popular. Anything from a process and improvement point of view around smart contracts. Fast forward kind of 10 years later, nothing really goes down that proof of concept rabbit hole. It's all straight into productions with people that bought into the idea.
It's amazing to see the amount of adoption taking place of blockchain technology and the crypto asset class. You have almost all of TradFi here, the banks, the stock exchanges, the payment companies, they're all here. What does it mean to you, or how do you see that with all these folks coming in? Is it just, you can't ignore this technology, this is the future?
Pretty much, yeah. Like it's just been insane that it's kind of been this almost light switch moment. It felt like for a long time we were talking about institutions coming and regulations coming, and now it finally feels like it's arrived. So the starting pistol has sounded in my mind. Like by no means do I think we're kind of nearing the end of the race. It just feels like the race is starting. And I'm quite fortunate I'm in New York this week, like the financial powerhouse of the world. And when you meet with the likes of BlackRock, Fidelity, Franklin Templeton, like you understand that they're taking this technology incredibly seriously and they're making these big investments. And my view in these things is like the BlackRocks of the world don't make bad bets. Like they understand, they do an incredible amount of due diligence. So it's nice to kind of see them endorsing the technology in this way.
Yeah, absolutely. So give us an overview of Lido. What is Lido, your mission, your services, and much more?
For your listeners, you can think of Lido as a liquid staking protocol. And there's effectively kind of different levels. I would say the one that's most common or the one that gets the most amount of attention right now is native staking. So
Mhm.
effectively with Ethereum, it's a proof of stake blockchain. So what that means is you take your ETH, you secure it in the network. And as a reward for taking your ETH, securing it in the network, you're given rewards. So I believe the rewards rate right now is around 3%. The issue with native staking is that you're basically taking your capital in the form of ETH, you're locking it away. So from a capital efficiency perspective, that's not terrific or it's not ideal. I suppose then the whole selling point of Lido and liquid staking is we're solving that problem. So the whole process with Lido is basically you would take your ETH, you would go to the DApp, take your ETH, stake it, and in return you're given STETH or ST ETH in return. And you can think of STETH as a certificate of deposit. And that certificate basically represents two things: the ETH you've just staked and your staking rewards. What's really cool about STETH is effectively the network effects of it. So you can take STETH, use it as collateral, deploy it into DeFi, generate yield. But added benefit is that instant liquidity. So
Mm.
you can take that STETH and swap it into stables. And that's a key selling point for a lot of institutions. They don't want to be beholden to the withdrawal queue. So I think the withdrawal queue right now from a native staking perspective is around 2 weeks. So Tony, like like the market can change quite a lot in an hour, let alone 2 weeks.
Yes.
So for a lot of institutions, they don't really want that exposure to time. So again, from a liquid staking point of view, the ability to take STETH and go into stables is a tremendous selling point for what Lido is and what STETH is.
Yeah, absolutely. And you can put your capital to work, and it's great to
Mm.
have that liquidity, like you said, instant liquidity. So talk to us about the mechanics of how this is all set up. I'm assuming it's using smart contracts. How's the custody done, and security and all these things? Because that's going to be the big question for a lot of folks.
Yeah, so I should say like Lido is a DAO, so a decentralized autonomous organization. So one of the cool things about Lido is that it really practices what it preaches. So it's all around decentralization. So Lido is effectively a middleware. Nothing is actually staked with Lido directly. So
Mhm.
there's over 600 different node operators operating with Lido today or through its middleware. So there's a couple of different elements to that. Like you would have what's called the curated set. So this is like professional node operators. So that would be the P2Ps of the world, Figments, Kilns, Chorus Ones. And we also have the community staking module. So again, driving that decentralized element. Like there's a big focus within Lido and all the contributors that you want to make Ethereum as decentralized as possible because ultimately that was the goal of the technology from the very beginning. Again, at a high level on like the setup. And then from the custody point of view, this would come up quite a lot with the institutions that we deal with. So the asset managers, liquid funds, and ETF issuers. From a custody point of view, we've quite good coverage. So that would be the likes of Fireblocks, Copper, SFU, Hextrust, and the one that's most recently been announced is with BitGo.
Mm.
So I would say like when we go and speak to these different asset managers, like unless you have custody support, they're very unlikely to go touch the asset. And because ultimately the custodian provides a terrific service, especially on the infrastructure side. So a big priority for me is making sure that STETH, this institutional ecosystem at a foundational level, is supported with as many different custodians, MPC wallet providers and tech partners as possible.
Yeah, that definitely makes sense. And custody is such a big aspect for trust and making sure assets are secure. It's great to hear you're using some of the biggest names in the industry like BitGo and so forth. So, on that note, in pitching the liquid staking and your services to institutions like BlackRock, many of them are bullish on Ethereum. They have it in ETFs format. Some are companies are holding it as a corporate treasury, and then they want to earn that yield, right, from the staking rewards and so forth. How are you pitching this to them? Are they are they being open to the idea? I know some folks, it's a matter of education, right, and getting
Yeah.
familiar with all these things. But how has it been pitching this service to those institutions?
It's been quite good. Like you said, like education is a big part of it. Like at the end of the day, people are not going to engage with a technology or use any kind of service unless they're comfortable with it. But maybe to kind of take an example you mentioned there, so like the ETF issuers, like there's obviously a huge amount of work happening behind the scenes with these issuers to get staking added to these products.
Yeah.
Um, One of the key things that comes up quite a lot in the conversations that we're having is that what will the staking rate be of these ETFs?
Mm.
So if you take kind of Europe as an example, so Europe has had staking in these products for quite a long time. And there's a number of quite successful ones like 21 shares, Bitwise through ETC Group. But the staking rate of these products tends to be at 50%. And the reason for that is again liquidity. So when a client wants to take money out of their ETP or ETF, it's typically operated on like a T plus two basis. So they want to get their money back within 2 days. The issue when you have a natively staked ETP or an ETF is that it typically could take around 2 weeks.
Mhm.
So from the issuer's point of view, that's why they have to have a certain amount of liquidity. And by liquidity, I mean unstaked ETH. Back to your point around like what's the sales pitch? The sales pitch from us would be you could actually launch a 100% stake product. You can have a product that's now 100% staked, which means you're getting the full 3% yield compared to say a 50% stake product where it's only getting 1.5%. So from the issuer's point of view, that's obviously quite attractive. You can launch a better product. And then from the investor's point of view, you're getting higher returns and you're again getting a better product in its totality.
That's really great and a huge incentive, to your point. And then I'm assuming it would be very similar for Ethereum treasury companies as well if they want to do the same thing.
Exactly. Yeah. So I think one of the big reasons why e-treasury companies have been such a popular topic right now is again because ETFs don't have staking yet. So I think you have the likes of Sharplink Gaming and the Trust Machine and the Ether Machine, like they're seeing a significant amount of attention because ETFs don't stake. And I do think there is a world where both will kind of sit in parallel. Like these treasury codes can be a lot more aggressive in terms of the strategies they deploy. They might have a DeFi strategy, they might have a liquid staking strategy, they might have a looping strategy. And whereas the ETFs for staking, it'll be relatively straightforward. It will just be hold ETH, stake it. So from a returns perspective, it probably would be lower compared to, say, a treasury co who could be a little bit more aggressive depending on the strategy that they want to deploy.
So that's interesting. And I can see why the Ethereum treasury companies, there's kind of a race to get as much ETH as possible because if the ETFs are not offering this yet, and we're still waiting for the SEC to actually do something and, tell us if they're going to, but also the ETH treasury companies seem to have more play, so to speak, or more wiggle room to do more versus the ETFs.
Yeah, exactly. So like, I think Sharplink Gaming is probably the best example, or one of again the largest in the space right now. I think that just is giving an opportunity for investors to get the exposure they want right now, instead of waiting for the SEC and clarity around staking ETFs. And at the end of the day, liquid funds, asset managers, they do act as kind of mercenary capital. They want to go and get exposure to the market, especially since now is quite a good time for ETH. Like it does feel like the narrative has really changed compared to say the beginning of the year, where I always quite honestly say I don't think ETH was getting enough love. Now things have really changed where we're in nearly the end of August and it's getting the attention it deserves. And a big part of that is obviously regulatory clarity coming out of the US and again what these treasury codes are doing and how aggressively they're buying ETH. Like it is a terrific endorsement that look, this is now a strategy that's being deployed so actively.
One of the things I was curious about, and I don't know if you can speak to this because it depends on the companies, but could they offer the treasury companies the staking rewards as a dividend to the shareholders, or maybe just simply reinvest the amount to drive more value on the stock side? What do you think about that? I know this goes more into the companies themselves.
Yeah, I think you're right at the end there. Like it ultimately depends on the company. So, and the strategy they want to have. Like, it was quite interesting listening to the different investor calls for these e-treasury companies. And again, this is kind of a greenfield space. Like, nothing has been around for 20 years and there's no real standards yet. Everyone is still trying to find what works and what doesn't work. So, I would say there's no real right answer, there's no real wrong answer. I would say, from the investor's point of view, the right answer is the one that makes the most amount of money or the highest return.
Now, the SEC recently gave some guidance on liquid staking, saying some of these activities are not securities. What does that mean for your business and even the future of liquid staking?
Yeah, well, at a high level, it's terrific.
Mm.
because this has again been something that comes up quite frequently. So, like when you speak to these big asset managers or issuers, they want one thing, and that is clarity. They want to know what the rules of the game are. Like it's very easy for me to go and have all these different conversations, but if there's any kind of regulatory doubt in the background, they're very hesitant to get involved. And that's quite fair. Like these are big institutions, tier one, have probably been around hundreds of years. They have quite a low risk appetite and they don't want to offend the regulator. So
Mm.
when this news came out around clarity around liquid staking, it was terrific because now we know what we can do and what we can't do. So liquid staking not falling under securities law is a big part of that.
Yeah, absolutely. And I know there's still more that they need to provide, but this was a good start. And hopefully maybe with the clarity bill, the market structure bill that's coming to be passed by Congress, maybe there's some additional language there, or maybe not. Maybe the SEC provides the full guidance later this year.
Yeah, absolutely. Like that's what everyone wants. Like again, kind of going back to my Deloitte days, like it was funny, no one really wanted like regulation. They didn't want like the government to come in and like dampen innovation. But I think people soon realized that look, like regulation is not a bad word. It's a good thing. Everyone just wants to know what you can and can't do. And ultimately the structure is the foundation of how big things happen. And I think if there wasn't this regulatory clarity, um, less would be happening in the market today. Like it's again kind of going back to the beginning of the year. I was here in January, the week of the inauguration, and I did feel like there's this like terrific energy in New York where okay, things are opening up, innovation's happening.
Mhm.
Whereas I think maybe 2 or 3 years ago, that energy wasn't there. And a big part of this new energy is obviously new administrations, and again that regulatory clarity that's now starting to come, or is at least quite close to being kind of launched or live.
Yeah, for sure. And I think, I think people sometimes think that if there's regulations coming in that is going to stifle innovation, but it's just a balance. I think if you get the balance right, where you're not stifling innovation, but you're protecting consumers and users, that's fine, right? You allow the entrepreneurs to build, the innovators to do their thing, and there's protections for consumers. And I think that's the balance we just have to strike. But I know to your point, like some people think, oh, if you let the government come take over, we won't be able to do anything. But it's not true as long as you are able to get balanced regulations.
Yeah, and I think like once the regulators are actually listening to the market, like it would be quite bad if the regulators went into a black box. They did all their research and they didn't engage with the people on the front line. I think that's when you have big issues. Whereas like what the SEC is doing with the crypto task force, speaking to as many different people on the front line as possible, that's where you start getting meaningful regulation. And that's where again, that confidence starts to grow that, okay, this is a serious technology and serious players will want to get involved.
You mentioned engaging with regulators. I don't know if you're able to talk about this, but have you and, and folks on your team spoken to the SEC about your services and, you know, giving them feedback and things like that?
Yeah, there's definitely conversations and there's engagement there. Like there's a number of different kind of liquid staking groups and staking groups where as effectively a collective, we would go and we would speak to, say, the task force, or if there's kind of open questions, given that Lido is the largest liquid staking protocol, like our guidance would hopefully have some weight and we would just give feedback on what we think is the most appropriate.
Will Lido expand beyond Ethereum? There are other proof of stake blockchains out there, other services that offer, or other blockchains that have staking integrated, like Solana, for
Mhm.
example. Are you just going to stay with Ethereum and the ecosystem around Ethereum?
I think like my view on this is like if you want to do something incredibly well, you have to focus on doing that one thing incredibly well. And for us, that's Ethereum staking. So in the past, there was some liquid staking offerings within Lido, but that was effectively sunset. Again, kind of based on that decision, you want to do something well, you just focus on doing that.
Mhm.
And again, kind of my own personal opinion on this, like Ethereum is probably one of the only kind of institutional grade blockchains out there today. So like, why not focus on the one that's getting the most attention, and that is Ethereum.
Yeah, that's a great point because, and we could talk a bit about this. Ethereum usually seems to be the first platform or blockchain that is being used for tokenization. And there's the majority of stable coins out there are on Ethereum. When BlackRock and some of these other funds launched their tokenized money market funds, it was on Ethereum. And yes, they branched out, but ETH seems to be the starting point that it's the most trusted. The ecosystem with maybe the most liquidity, a lot of network effects, obviously, and things like that. So do you see ETH continuing to hold that mantle of being, let's say, the top enterprise blockchain?
Oh, absolutely. I think there's no doubt. Like obviously Ethereum, second largest blockchain after Bitcoin. Like Ethereum has kind of two key selling points, like security, 100% uptime, and then like you mentioned, liquidity. Like the type of conversations I'm dealing with or the type of conversations I'm having with people, they really do care about those two things quite a lot.
Mm,
Like institutions, they're not going to engage unless they feel it's secure. And then a liquidity point of view, they're not dealing in hundreds of millions, they're dealing in billions.
mm,
So they want to know how much they can sell, how long it takes to sell. And there's really no one else kind of operating at that scale or that size where big institutions can get involved. And then on the final point around network effects, like again, you have Visa, MasterCard, BlackRock, Fidelity. Like these are all big players. And for me, I think they place big long-term bets. It's never about a quick win. I think again, depending on the strategy of like the firm you're dealing with, quick wins can be quite good. Whereas if you want to make meaningful changes, that long-term bet is far more important. And Ethereum has been around for quite a long time now. It's proven that it's battle tested. It can handle a lot. It's changing with the times, like the move from proof of work to proof of stake. Like these are all endorsements that look, this is a very future-focused technology.
Usually I see these comments online on social media. People criticize, oh, ETH gas fees are high. But I would love to get your perspective on the institutions kind of look past that because to your point, they look at security, network effects, liquidity. Is it that or is there more to it?
Hmm. Yeah, it's funny. Like the gas fees, I would say comes up more from a retail point of view, which is incredibly fair. Like if there's a high amount of congestion on the network, paying $30 to process a transaction, not exactly ideal. And I think we all know that. And the EF is doing a significant amount of work to make those changes. So yeah, I would say from an institutional side, it doesn't come up a lot in conversation. Um, like if you look at kind of the traditional finance world, $30 transaction on a couple of million and would be incredibly cheap.
Yeah.
Whereas it's so yeah, you're not really comparing apple to apples in that sense, or apples and oranges.
Okay, so
Um,
that's a great perspective because I think to your point, retail just thinks about their little mini transaction, which I get, right? But if you're BlackRock and these other institutions, you're moving billions or millions, and you pay even $100 in fees. That's nothing.
yeah, no, exactly, and like it's peer to peer.
Mm,
Whereas compared to like traditional kind of payments model, like if I want to send money from Dublin to New York, it probably has to go through two or three different banks before it gets there, and it takes 4 or 5 days. Whereas again, the efficiency improvement with Ethereum, again, we all acknowledge it can be expensive, but that efficiency improvement where it happens in minutes, not days, is terrific. And it will only get better as more and more people join the ecosystem and they build kind of different technologies on top of ETH or Ethereum.
So speaking of that, the technologies on top of ETH, you got a lot of roll-ups, right? The L2s, and we're seeing adoption of L2s. Like I just spoke to Vlad Tenev at Robinhood, and they're using Arbitrum, to base their blockchain and tokenization efforts. And you have a whole bunch of other layer twos, right, that are getting adoption in different ways, even by institutions. But maybe those could serve the retail who are worried about the high fees. Go to a layer two that is still using the security from the base layer of ETH, and that would be the nice fit, so to speak.
Yeah, of course. And then especially like when you have the big exchanges like Coinbase, I think has the base L2, Kraken has their own L2, and Consensus has Linea. Like a big part of the success for L2s, in my opinion, is distribution. So
Mm.
when you're a Coinbase or when you Kraken and you have a new L2 that you launched and you already have excellent distribution, like it really is set up for success right from the very beginning.
Let's talk about the future of staking, right? I know it's still early. I know a lot. We're still getting clarity, right? We're still waiting on certain clarity from like the SEC and so forth. But let's say 10 years from now, what does staking look like? Is it just simply built in? And if whether I'm a retail or I'm an institution, I'm earning these passive rewards if I hold the respective token?
Yeah, so I would say future of staking, like big kind of idea right now, or at least from our point of view, is institutional adoption is only going to increase.
Hmm.
Like once we get more regulatory clarity, once there's and maturity of infrastructure and education, of course, is a big part of that. Like I think it is going to only increase and that is going to go up. Other big elements, I would say decentralization. So again, that's something Lido is doing a terrific amount of work on to make sure that Ethereum remains decentralized. Like there's been a lot of concern where you have big centralized exchanges. They have a tremendous amount of control. Some may say too much. They may not be the most transparent. Whereas if you were to use, say, someone like Lido and its middleware, it's incredibly transparent because it's a DAO where everyone can make a vote if they want to bring changes to the DAO. And again, around having 600 plus different node operators, like really no one is doing anything compared to Lido in terms of making Ethereum stronger and more decentralized.
Yeah, that makes sense. And then I wonder if with all these institutions like banks and so forth adopting ETH and doing liquid staking, using Lido and whatever it may be, that the average user, the average Joe and Jane, they don't necessarily go buy crypto on Coinbase and hold it directly. They're going through the banks, and the banks are giving them some of these staking rewards, and it's better than the traditional interest that's being paid out in checking and savings accounts, right? So it gives more opportunity to earn higher yield and better returns, and the institutions can share some of that.
Absolutely. Like for me, I think real adoption and like mainstream will happen when you're not going to be talking about staking or decentralization or where the nodes are located. Like it will just get to a point where I go to my brokerage account, I buy ETH, and in the background it's automatically staking and it's a given. And I think that's probably what like BlackRock sees, like based on the Ether product. Like they're not going to launch a second ETF. They're not going to have one that's staked versus unstaked. Like
Uh,
based on the filing that I've seen, it's just going to be one product with staking. Like, so for me, that just makes sense. Like, why would you want to leave all those rewards on the table? It's just, again, that capital efficiency element is just critical.
Yeah, that makes sense. And I know some people had talked. Well, we're putting the idea out there that maybe there's a separate ETF, but to your point, doesn't really make sense. And then it's better just keep it in that same ETF, and then you can either pay it out in some sort of reward or dividend, or just keeps reinvesting and compounding.
Yeah. And of course, then it's obviously a case of like how much of it is staked. So
Mm.
again, back to that analogy of like in Europe, like only 50% of the AUM is staked. When we go and we speak to different asset managers, we're really leaning on that. Like, okay, 50% is good, 100% is far better. So
Mm.
you could almost have potentially a combination. You could have 50% natively staked, 50% liquid staked, or you could have 100% liquid stake product. So again, you're kind of offering customization, and that's a big part of what these institutions want. They want to have flexibility. And one of the new products that Lido is working on is ST Vaults and like Lido V3. And a part of that is offering that customization where different asset managers can pick the custodian they work with, pick the node operator, and choose if and when they mint ETH. So
Wow.
again, this kind of goes back to like the future of staking. That's why I really believe that institutional adoption is only going to grow.
I love that customization so they can choose what they want to do. That's really great. Are there any criticisms out there or things people have said that maybe this is risky that you would want to address? Or are there common themes? People put us on social media, what it may be, is saying, "Hey, this is risky." I know you mentioned like you're trying to be more decentralized, avoid centralization. So, how would you address some of the critics and about certain risks and things they may have highlighted?
I would say like the biggest criticism that comes up, and again, I think this is just more from like a lack of knowledge, is that like Lido has too much control.
Oh, okay.
Um, like there's a centralization risk from Lido. I think like Lido's market share is around 25% right now. But one of the key things that people forget is that Lido is a middleware. Nothing is actually staked with Lido.
Mm.
Like when you go on the DApp, you take your ETH, you stake it, it's distributed across 600 different node operators. So yes, the headline Lido has 25% market share is terrific and that sells clicks. That's true. But in reality, when you start looking at it, like Lido is doing a terrific amount of work to make sure it's being distributed as much as it possibly can. So I think the curated set, like I mentioned, professional node operators, we have community staking module, we have solo stakers. We're trying to remove those barriers for community stakers and solo stakers to get involved and making it as easy as possible for them to run nodes. So I would say that's the criticism that comes up quite a lot, but it's not founded on any real merit. It's more someone has seen a headline and they haven't decided to read the actual article.
That's a good one. Yeah, I've seen that one, so I appreciate you addressing that. Are you able to share the names of any institutions that are using your service, TradFi institutions? It's okay if you can't, but I gotta ask.
No, it's a fair question, but my answer will be quite high level. So the usual kind of tier one asset managers funds. We have a number of different liquid funds that use us every day. Um, I would say on the collateral side of things, you would see Steve used as collateral um, by these major kind of liquid funds.
Mm.
But unfortunately, my answer is going to have to be quite high level on that one.
Totally understand. What's on your roadmap? I know you mentioned some things, that you're working on customization and so forth. Anything else you wanna highlight?
Yeah, the big one for us right now is kind of Lido V3 and SD Vault. So
Mm.
um, like again, I feel like it's kind of beating the drum on this. Like the whole decentralization narrative for Lido and Lido Core is terrific. But one of the big pieces of feedback we've gotten from asset managers is that look, we love what you're doing, supporting decentralization. We love the liquidity we get for ETH. But for our internal risk department, that's a bit of a challenge to kind of get them over that hump.
Mm.
So the whole idea with SD Vault is that customization piece. So again, the idea that you can choose the custodian that you work with, whether it's BitGo, Copper, Fireblocks. You can choose a node operator that you work with, Figment, Kiln, Chorus One, or whatever it may be. And then the final part that's really attractive is that you can decide if and when you mint ETH. So you could have 100% natively staked vault. Maybe a redemption request comes in. That's when you decide to mint ETH and get out of your position. What I would say, the customization part is amazing. Like I kind of look at it as I have an extra tool in the toolbox when I go and speak to these asset managers where I can say, look, if you're comfortable using Lido Core, get all the benefits there, go down that route, like that is terrific. Whereas if we speak to kind of institutions where they're more risk adverse, we can say, look, here's a custom setup. You can work with the custodian you've been dealing with for the past 10, 15 years. Here is the node operator that you've already onboarded. You have an SLA with, you have an insurance policy in place. And then we come along with the added benefit of liquidity.
I wanted to get your thoughts on the general crypto market at large. There's a lot happening with tokenization and stablecoins. Obviously, we got the Genius Act passed, and it seems like everyone's going to launch a stablecoin, banks, and much more. Let's start with stablecoins. What are your thoughts on that market, and do you expect a massive boom?
I think, yeah, at a high level, like anyone who says different, like where there's not going to be a big boom is probably just crazy. Like, again, going back to the point of like regulatory clarity is the terrific thing. Like, people know the rules of the game. And once you get to a point where you're not expecting kind of negative regulation or penalties in place, innovation will usually follow. And I think like what USDC is doing, Circle, all these huge successful IPOs, it does highlight that there's significant demand from the capital markets to actually get involved in these type of use cases. So I would be very surprised if like stable coins is not the next killer use case for blockchain.
On the lines of stablecoins, you got the tokenization. We were talking about BlackRock's and money market fund. There's tokenization of real world assets happening. That market is growing as well. What are your thoughts on that? Do you see a lot of the traditional assets, stocks, real estate, and so forth being tokenized on the blockchain?
I think so. Like BlackRock's Biddle Fund has been hugely successful. Like real world assets, again, tokenizing just makes a huge amount of sense from a liquidity point of view. Um, like everyone wants liquidity. So when you especially take an asset like property, a liquid for centuries, and suddenly a technology has come along with blockchain and tokenization where you can make it liquid, fractionalized ownership, like these just make a huge amount of sense. And then on the other side of that, around like bonds and commodities, like the trading of that, automating with smart contracts, making it more efficient, like it kind of sells itself.
Yeah. Absolutely. Yeah, it's exciting. A lot happening in the industry. And I think as we get the Clarity Act in place, passed by Congress here in the United States, I think the innovation is just going to surge. There's going to be a lot of building. Keen, great stuff. Love what Lido's doing. And, I'm a ETH holder and a staker myself. So this is
Great.
really, really great stuff. But I got some wrap up questions here for you. First, if you could create your own metaverse, what would the theme be?
I'm a big golfer, so probably golf related.
Rapid fire questions. Favorite food?
Steak,
Favorite musician or band?
uh, Beatles,
Favorite movie?
Interstellar,
Favorite book?
how to make friends and influence people.
And when you're not working at Lido, what are you doing for fun?
Golf when I can.
Yeah, that makes sense. Keen, great stuff, man. I love again what you guys are doing, and I absolutely believe in it. I'm looking forward to hearing some big announcements of your service being used by some of the biggest firms in the world, and we'd love to have you back on in the future. But thank you so much for joining me.